Okay, let's unpack this. It is officially February 2026.
Here we go.
The holidays are deep in the rearview mirror. The Super Bowl is either about to happen or just happened, depending on when you're listening. And the winter freight lull is hopefully starting to thaw just a little bit.
Quite fully.
But we have arrived at that other season, the one that arguably causes more stress than a level 1 DOT inspection
Oh, yeah?
on a rainy Tuesday in New Jersey.
You are talking about tax season.
I am absolutely talking about tax season, and specifically for our friends behind the wheel. Because, look, I've been reading the forums, I've been looking at the feedback, and if you are a truck driver right now, scrolling through social media or listening to the chatter at the fuel island, you are probably hearing just a deafening amount of noise.
It's overwhelming.
It feels a bit like you've been dispatched to a load, you're 50 miles down the road, and you realize you only have half the details on the rate con.
That is a very, very apt analogy for the current tax landscape in trucking. It's a situation where the signal-to-noise ratio is, it's incredibly low.
Right. You've got people shouting about new laws. You've got rumors about free money from the government.
The free money away.
And then there's this thing called the One Big Beautiful Bill, which honestly sounds like something a marketing team dreamt up after 3 pots of coffee.
It does have that ring to it.
But it's apparently the elephant in the room, or maybe the oversized load in the lane.
It definitely is the oversized load. The One Big Beautiful Bill, or OBBB as we'll probably call it, has really just dominated the conversation this year.
Yeah.
But the problem is, as with any massive piece of legislation, or even just the discussion surrounding legislation, it creates a lot of fog. It creates a scenario where drivers are making, real financial decisions based on headlines rather than the actual tax code.
Exactly. And that is our mission for this deep dive. We are not here to be an audio textbook.
Please no.
Nobody wants me to read IRS Publication 15 to them for an hour. That is a cure for insomnia, not a good way to spend your time.
Right.
We are here to take a massive stack of articles from Freight Pro Hub, who have really been on the ball with this stuff, and separate the internet noise from the IRS reality.
Which is a crucial distinction. The internet operates on speed and clicks. The IRS operates on statutes and audits.
And they do not speak the same language?
Those two things rarely align. No.
So let's do a quick target audience check-in. Whether you are an owner-operator with your own authority, a company driver on a W-2, or maybe you're just tax curious.
Tax curious, I like that.
Because you're thinking of buying a rig and hitting the open road, this is about keeping your hard-earned money. Because while everyone is hyper-focused on some flashy $7,500 tax credit they saw in a TikTok video, most people are missing the silent deductions that can actually save them thousands.
And that's really what defines the stakes here. In many professions, taxes are just a nuisance. You file them, you grumble, you move on.
It's just a thing you do in April.
Exactly. In trucking, the margins are so tight, especially with fuel volatility, insurance rates, spot market fluctuations. The difference between understanding the tax rules and just guessing.
Yeah.
It can literally be the difference between a profitable year and going under. It's that serious.
I love that quote from the source material we're looking at today. It's combat wisdom. Don't build your tax plan on internet noise. Build it on what you can prove.
That is the core philosophy we need to adopt today. Proving it to the IRS is the only thing that matters, not what you hope is true.
Okay, so let's dive right into it. Section 1, the OBBB, fact versus fiction. We have to clear the air here because this one big beautiful bill concept, it's just confusing people.
Yeah.
What exactly is it?
Well, here is the reality. The One Big Beautiful Bill has become what we call a bucket name.
A bucket name.
In the trucking community, OBB have become shorthand for everything Congress is currently discussing regarding supply chains, labor, and infrastructure. It's all just thrown into one bucket.
Oh, okay. So it's like when people in some parts of the country call every soda a Coke.
That's the perfect analogy.
Right.
Or when every tissue is a Kleenex. Drivers are hearing about a proposed bill in the House, a Senate discussion on overtime, a completely separate IRS update on depreciation. And they are lumping it all into this one big, beautiful bill narrative. They assume it's all one package. And more dangerously, they assume it has all passed.
So a driver hears about a bill that might pass, assumes it's part of the OBBB, which they think did pass, and suddenly they're, on the phone with a boat dealership.
Precisely. They're spending money they don't have.
Yeah.
To navigate this, we need to use the 2 lanes concept. I think this is the best way to visualize the tax landscape right now.
Okay, I like this. Break down the 2 lanes for us.
So think of tax planning like driving on the interstate. Lane 1 is the right lane.
The slow lane.
The slow lane, the boring lane. This is law. These are things that exist, are enacted, have been signed by the president, and are printed in the IRS tax code. You can file these on your 2025 returns right now. It is solid ground.
Safe driving, boring maybe, but you aren't getting a ticket in the right lane.
Correct. Then you have lane 2. This is the passing lane.
Oh, right.
Or maybe more accurately, the fantasy lane.
The fantasy lane, I like that.
This lane contains proposals. These are real bills with real text that have been introduced in Congress. They have sponsors, they have names, but they have not passed.
So they're not law.
They are not law. They are essentially a legislative wish list.
Okay, so let's apply this 2-lane filter to the biggest rumor out there, the $7,500 truck driver tax credit.
Yeah.
I have seen this everywhere. Get your $7,500 check. The government wants to give you money, all this stuff. Is this lane 1 or lane 2?
That is firmly 100% in lane 2, the fantasy lane.
Oh, man. That is going to break some hearts. I can hear them now.
And it's important to be brutally honest about this. The rumor stems from a specific real bill. It's called the Strengthening Supply Chains Through Truck Driver Incentives Act of 2025.
So it does exist.
It exists as a piece of paper in Washington. It was introduced in the House. It proposes a refundable tax credit for qualifying commercial truck drivers to help, retain talent in the industry.
And refundable is the key word, right? That means even if you don't owe taxes, they send you a check.
Correct, which makes it incredibly attractive. A deduction just lowers your bill. A refundable credit puts cash in your pocket.
But,
and this is the critical but, it is not enacted law. It is stuck in committee. It hasn't passed the House, it hasn't passed the Senate, and it certainly hasn't been signed.
So let's play out the scenario. It's February 2026. I go to my tax guy, I sit down, I dump my shoebox of receipts on his desk, and I say, hey, file me for that $7,500 driver credit. What happens?
Okay, a couple things. If your tax professional knows what they are doing, they will look at you and say, that doesn't exist. We can't file for that.
Okay.
If they don't know what they are doing, or worse, if you're using some shady tax mill that promises these huge refunds and they file it, you are in for a world of hurt.
How much hurt are we talking?
You are filing a return claiming a credit that has no legal basis. The IRS has zero authority to issue that money. So, best case scenario, the IRS computer simply rejects your return.
Just kicks it back.
Kicks it back. And you have to refile, delaying your legitimate refund by weeks, maybe months.
And worst case?
Worst case, you get flagged for a frivolous return.
That sounds bad.
It is.
Yeah.
That opens you up to a full audit of your entire financial life. Not just the credit, but everything. Your fuel, your maintenance, your per diem.
Mm-hmm.
They will look at it all.
It's basically like waving a giant red flag that says, hey, IRS, look at me. I'm making up laws.
Exactly. You never, ever want to wave a red flag at the IRS bull. It's just not a good strategy.
But let's play the what if game for a second because people are optimistic. Let's say a miracle happens and it does ever move from the passing lane to the right lane. What would it actually look like? Are all drivers getting this check?
No. And that is the other part of the myth that gets lost in the social media posts.
Yeah.
Even the proposal has strings attached.
Of course it does.
It's tied to CDL status, obviously. It requires a certain number of hours worked. The current draft says 1,900 hours a year, which is basically full-time. But crucially, it has income caps.
Ah, the means testing.
Right. The goal of the bill is to help the rank-and-file driver, not the fleet owner. If you are a high-earning owner-operator netting $150,000 or a specialized heavy-haul driver making big money, you likely wouldn't qualify even if it passed.
So it's not a blanket check for everyone with a CDL.
Not at all. It's designed for the middle-income driver.
So the advice right now is don't spend the money. Do not go buy the base boat.
Please don't. Treat it like a rate confirmation that hasn't been signed.
That's a great way to put it.
You can track your hours. That's smart regardless for many reasons, just in case it passes retroactively. But do not build your budget around it. Do not buy a new TV expecting that $7,500 check to cover it.
Okay, let's look at another big rumor attached to the OBBB. The no tax on overtime rumor. I've heard this one a lot too. The government realized truckers work 70 hours a week, so they eliminated taxes on overtime pay. True or false?
That is largely a myth. And it's a painful one because it stems from a fundamental misunderstanding of how labor laws work in trucking versus, say, the rest of the economy.
Explain that. Why wouldn't truckers get the same overtime tax benefits as a factory worker if a bill like that passed?
It all comes down to the Fair Labor Standards Act, the FLSA.
Okay.
Historically, trucking has had special treatment, and I'm using air quotes here, specifically the motor carrier exemption.
Right.
This exemption essentially says that because drivers are regulated by the Department of Transportation on safety and hours of service, they are exempt from the standard FLSA overtime rules that require time and a half pay after 40 hours.
So most company drivers aren't technically getting overtime pay in the eyes of the law.
Precisely.
They're just getting paid for more miles or more hours, but it's at their straight rate.
Exactly. If you're paid by the mile or by the load or even hourly straight time, you don't have a line item on your pay stub that says overtime pay. So if a tax bill says overtime pay is tax-free, but your pay stub doesn't show any overtime pay,
then you get zero benefit.
you get zero benefit. The deduction doesn't apply to you.
So the OBBB didn't fix the underlying labor issue. It just sort of put a Band-Aid on a problem that truckers can't even access.
Correct. It's not that the tax bill forgot truckers. It's that the labor rules often don't classify truckers as eligible for overtime in the standard way to begin with.
Wow.
Unless that FLSA exemption is removed, which is a massive, massive legislative fight in itself. A tax break on overtime is useless to 90% of the industry.
Man, that is tough. It really highlights why you can't just read a headline and assume it applies to you.
No.
You have to look at the mechanics. You have to understand the engine under the hood.
The mechanics differ from the headlines.
Always.
Which brings us to the foundational mechanics of trucking taxes.
Yeah.
Before we even worry about credits or fancy new bills, you have to know your rig, so to speak.
Yes.
You have to understand the difference between being a 1099 independent contractor and a W-2 employee. This feels like the eternal debate in trucking. Which pays better? It is the eternal debate. But from a tax perspective, this isn't just about the paycheck size. It is about who the IRS thinks is responsible for the existence of the business.
Okay, let's strip this down. What is the core distinction?
If you are W-2, you are an employee. The company controls the job. They tell you where to go, when to be there, and usually they provide the truck.
Right.
In exchange for giving up that control, you get simplicity. They withhold your taxes, you drive, you get paid, the taxes are handled.
Safe, simple, predictable.
If you are 1099, you are a business entity. Even if you don't have an LLC, even if you are just a sole proprietor using your Social Security number, the IRS sees you as a small business.
You are the business.
You are the business. There is no withholding. You get a check for the gross amount, and you're responsible for everything.
And when you say everything, let's talk about the silent killer of new 1099 drivers, the self-employment tax.
Yes, this is the one that trips everyone up. When you are W-2, you pay 7.65% of your pay for Social Security and Medicare. It's called FICA tax.
And your boss pays the other half.
Your boss pays the other 7.65%. It's a match. But when you are 1099, you are your own boss.
So you have to pay both halves.
You pay both halves. That is 15.3% right off the top of every single dollar you earn.
Okay.
And that's before you even get to federal and state income tax.
This is a huge, huge hit. But the trade-off is supposed to be deductions, right? That's the whole sales pitch for 1099.
Correct. And this is where we see the silent differences that are so critical right now. Since the Tax Cuts and Jobs Act a few years back, and this has continued through the current code in 2026, W-2 drivers generally cannot deduct unreimbursed job expenses on their federal return.
Wait, hold on. Let's make sure that lands, because I know drivers who are still saving receipts for this.
They are.
If I'm a W-2 company driver and I buy my own work boots, my own fancy Garmin GPS, my own Blue Parrot headset, and I pay for my own shower at the truck stop, I can't write any of that off.
On the federal level,
Yeah.
generally no. That deduction, it was called unreimbursed employee expenses on Schedule A. It was eliminated from most employees.
Just gone.
It's just gone. Unless you're in a very specific category, like a qualified performing artist or a military reservist, which doesn't apply to truckers, it's gone.
So all those receipts in the shoebox for a W-2 driver are just kindling.
Unless your state has a specific deduction, which if you do, but federally.
Yeah.
If your employer doesn't reimburse you for those items, you are eating that cost with after-tax dollars.
That is brutal. That feels incredibly unfair.
It is. It shifted the burden. Whereas a 1099 driver can deduct all ordinary and necessary business expenses. And that's a very broad category.
This is why you see such a push for the independent contractor model from some carriers.
Of course. It's just tax liability and operational costs from the company to the driver.
But there's a trap here, isn't there? The 1099 pays more myth. We see drivers jumping to 1099 because the gross pay looks so much bigger.
Oh, every day.
You know, oh, I was making $25 an hour. Now I can make $35 an hour as a 1099.
Let's do the math on that napkin right now because this is so important. You're offered $35 an hour on 1099 versus $25 on W-2.
That's a $10 an hour raise.
That looks like a $10 raise. Over a year, that's $20,000 more in gross pay.
Sounds great. Where do I sign?
Not so fast.
Yeah.
First, let's take your new $70,000 gross income. Subtract that extra 7.65% self-employment tax we talked about.
Okay.
That's over $5,300 gone immediately. So your $20,000 raise is now less than $15,000.
Okay, the gap is closing already.
Now, factor in the lack of paid time off. A W-2 job usually gives you, what, 2 weeks vacation? Some sick days?
At least.
As a 1099, you take a day off, you don't get paid. That's worth another $3,000 or $4,000 a year. Gone.
So now we're down to about a $10,000 difference.
Now, the big one, health insurance. W-2 jobs usually subsidize it heavily. As a 1099, you are buying on the open market. For a decent family plan, that could be $800, $1,000, even $1,200 a month.
Oh my gosh.
Let's be conservative and say it's $8,000 a year.
So suddenly that $20,000 raise is actually a pay cut of a couple $1,000s.
It's a pay cut.
Exactly. And we haven't even talked about the cost of accounting, the increased risk of audits, or the fact that you don't get unemployment insurance if you lose the contract.
And workers' comp.
As the source says, higher pay doesn't matter if the tax bill and the operating costs eat it alive.
You're trading a predictable paycheck for a business P&L statement. You have to be ready to manage that. You can't just be a steering wheel holder if you're 1099. You have to be a CFO.
You have to be the CEO and the CFO of U Inc.
Correct.
And many drivers are excellent at driving, but haven't been trained on running a business.
Okay, let's assume our listener is savvy. They are an owner-operator or a 1099 driver. They accept the risk. They're running the business. They want to know where the real meat is. What are the heavy hitters for deductions in 2026?
Well, here's where the current tax environment lane 1, remember this is real law, actually offers something solid and incredibly powerful. We're talking about what I call the nuclear option of tax deductions. 100% bonus depreciation. Nuclear option sounds dramatic. Break it down. What does that mean?
It's incredibly powerful for cash flow, but you have to use it wisely. Normally, if you buy a big piece of equipment, say a used Freightliner for $90,000, the IRS makes you depreciate that cost over several years.
Right. They spread it out.
They spread it out. You get a little tax break each year for, say, 5 years.
So I spend 90 grand today, but I only get to write off maybe 20,000 this year. That doesn't help my cash flow right now.
Exactly. But with 100% bonus depreciation, if an owner-operator buys qualifying equipment and places it in service in 2025 or 2026, they can write off the entire cost in year 1.
The whole thing.
The whole thing.
Whoa. So let's run a scenario. I had a great year. Let's say rates were high. We can dream a little.
You can dream.
I netted $100,000 in profit. I'm looking at a massive tax bill on that.
Yeah.
So I go out in December and buy a $90,000 truck.
You place it in service. You deduct that $90,000 immediately. Your taxable income drops from $100,000 all the way down to $10,000.
So I basically pay almost no income tax.
You pay almost no income tax. It's a game changer. It basically lets you reinvest your tax money back into your fleet instead of sending it to the IRS.
That's amazing. But you called it the nuclear option, so there has to be some nuclear fallout. What's the downside?
There is. If you take that massive $90,000 deduction in year 1, you have zero deduction for that truck in year 2, year 3, and year 4.
Ah, you've used it all up.
You've used all your ammo in one shot. So if you have another great year next year and you have $100,000 in profit again, you don't have that depreciation shield to protect you.
So you could have a very low tax year followed by a very, very high tax year.
Correct. You have to plan ahead. Don't just do it blindly because it sounds good. You might be better off spreading the deduction out.
And there's a catch about the vehicle type, right? I can't just buy a Ford F-150 for my administrative runs to the grocery store and write it off 100%.
The IRS is very strict here. To qualify for this full unrestricted bonus depreciation, the vehicle generally needs a gross vehicle weight rating, a GVWR over 6,000 pounds.
The famous Hummer loophole.
Exactly. A Class 8 tractor obviously qualifies. It's 33,000 pounds or more. A heavy-duty pickup like an F-250 or a Ram 3500 usually qualifies.
But a Honda Civic I used to get to the yard.
No. That is considered a passenger automobile and has very strict caps on how much you can write off each year. It's only a few $1,000s.
Got it. Okay. So bonus depreciation is the big one. Aside from the truck itself, let's talk about the daily bleed. The essentials.
Fuel is number 1. It is the lifeblood of the business.
Of course.
It can be 40, even 50% of an owner-operator's operating costs. You need to capture every single cent, every receipt, every fuel card statement.
And maintenance. I feel like this is where people get lazy with receipts.
They do. They remember the $2,000 turbo replacement. They forget the $40 wiper blades they bought in a rainstorm.
Right.
They forget the $20 bottle of DF they bought with cash because the pump was broken.
Small leaks sink great ships.
Exactly. Tires, oil changes, engine work, truck washes. If it's to keep the rig clean and professional, that's deductible.
What about tech?
Big one. Your ELD subscription, your GPS units, subscriptions to load boards like Diem or Truck Stop, services like Motive, or a pre-pass transponder.
So if it helps you navigate or find a load, it's a write-off.
If it is ordinary and necessary for your business, it's a write-off.
And then just the cost of living the road life, the day-to-day stuff.
To an extent, yes. Parking fees, which are getting outrageous in some places, are 100% deductible.
Yeah, they are.
Tolls, scales, CT scale fees, all deductible. Laundry is a funny one. You can deduct laundry costs, but only if you are over the road or OTR and away from home overnight.
What's the logic there?
The IRS knows you have to wash your clothes whether you're a trucker or a banker. But if you're forced to wash them at a pilot in Nebraska because you're away from home,
That's an additional business cost?
that's a business cost.
Yeah,
You can't deduct washing your jeans at your house on the weekend.
that makes sense. What about gear?
Personal protective gear, PPE, steel toe boots, high-vis vests, hard hats, safety glasses. If safety requires it for a job site you're delivering to, you can deduct it.
But not just my regular clothes, right?
Correct. Standard clothing blue jeans, t-shirts is not deductible, even if you only wear them to drive,
Why not?
because the IRS says they are suitable for everyday use. The standard is if you could reasonably wear it to the grocery store, you can't deduct it.
The IRS clearly has not seen what a pair of jeans looks like after a week of flatbedding. They are definitely not suitable for a movie theater, let alone a grocery store.
That is a very valid point, but unfortunately the tax code disagrees.
Now, you mentioned being away from home for the laundry, which brings us to one of the scariest, most misunderstood sections of the tax code for truckers. Section 4, the traps, specifically per diem.
Per diem, it sounds so simple. Per day, a daily allowance.
It does, and I feel like per diem is a word everyone uses, but almost nobody actually knows the rules. The myth is, I'm a trucker, I sleep in the truck, I get $69.09 a day of day tax deduction. Boom, easy.
And that mindset is a fast track to a very unpleasant IRS letter.
Okay, so what's the reality?
The reality is per diem is a standard allowance for meals and incidental expenses. It's a substitute, so you don't have to keep receipts for every single burger and coffee you buy.
Right.
But it only applies when you're traveling away from your tax home.
Tax home. That is the magic phrase. Define that for us, because I think a lot of people get this wrong.
This is the absolute kicker. Your tax home is generally your regular place of business or post of duty. If you don't have a regular place of business like a terminal you report to every day, your tax home is your permanent residence, the place you live.
Okay, so let's paint a picture. I'm 24 years old. I buy a truck. I want to save money. I give up my apartment. I put all my stuff in my parents' basement. I live in the sleeper berth 365 days a year. I figure I'm always on the road, so I always get per diem.
In that exact scenario, you likely get 0 per diem.
Wait, how? I'm homeless, essentially. I'm always traveling.
Exactly. The IRS calls that being an itinerant.
Itinerant.
Okay.
Sounds like a medieval bard or something.
In tax terms, it means you have no home base. You have no main place of business or residence. And the logic is, if you have no home base, you are never away from home.
Because your home is wherever the truck is parked.
Your home is wherever the truck is parked. Therefore, you are never traveling away from home for business, so you cannot claim travel expenses, including per diem.
That is wild. So the guy who thinks he's being clever and saving money by living in his truck full time is actually losing thousands, maybe $10,000 or more in tax deductions because he can't claim his meals.
Correct. It is a massive, massive trap. To claim per diem, you need to prove you have a tax home. And usually this means you are paying duplicate living expenses.
Duplicate expenses.
You pay rent or a mortgage at a home base, and you incur costs on the road. If you don't have that first part, you don't get the deduction for the second part.
So you need to pay rent somewhere, even if it's fair market rent to your parents for that room in the basement.
Yes. Get a lease agreement, write checks or do bank transfers. Create a paper trail that proves you have a domicile, a place you return to.
Wow. Okay, that's trap number 1, and it is a big one. What's trap number 2?
The mileage rate trap.
This one confuses me. Uber drivers use the mileage rate. Realtors use it. My friend who does sales uses it. I drove 10,000 miles, pay me 67 cents a mile. Why can't a trucker just say, I drove 120,000 miles, give me my deduction? It seems so much easier.
It would be easier, but it's not allowed. And the reason is because a semi-truck is not a Honda Civic.
Okay.
The IRS standard mileage rate is specifically designed for passenger automobiles. It's a simplified option for cars, light trucks, and vans.
And a Class 8 truck is definitely not a passenger automobile.
No. The operating costs are on a completely different planet. The depreciation is different. The regulations are different. For these reasons, most owner-operators are simply not eligible to use the standard mileage rate for a tractor-trailer.
So you have to use actual expenses.
You generally must use actual expenses. You track your fuel, your tires, your maintenance, your insurance, and your depreciation.
But honestly, let's just think about it from a practical standpoint. If you're driving a big rig getting, say, 6 miles per gallon and fuel is $4 a gallon, you are spending way more than the standard 67 cents a mile just on fuel and tires and maintenance.
Almost certainly. By a lot. If you tried to use the standard mileage rate for a semi, not only would it be an audit flag, but you would likely be cheating yourself out of tens of thousands of dollars in legitimate deductions.
So you're losing money and breaking the rules at the same time.
It's the worst of both worlds. You want to capture the expensive reality of that machine, not a flat rate designed for a sedan.
So don't be lazy. Track the actual receipt.
Systems over shortcuts. Always.
Speaking of receipts, let's talk about the stuff that gets lost in the cracks. Section 5, the scraps. The last-minute deductions that people miss. Why do drivers miss these small things?
Because they're so focused on the big ticket items. They track the $800 fuel fill-up, but they ignore the $50 CDL renewal fee. They ignore the $100 DOT physical. But over a year, these nickel and dime items add up to serious money.
Let's run through the list. Start with compliance costs.
This is the boring stuff that keeps you legal. CDL fees, the actual renewal fee, the cost of endorsement testing. If you need a hazmat endorsement to keep hauling your loads, that testing fee is deductible.
Okay, but there's a really annoying nuance here about new versus current careers, right?
Yes.
I want you to explain this because it makes me angry every time I hear it.
It is frustrating,
Right.
but it's a critical rule. The rule is you can deduct costs to maintain or improve skills in your current job or business. You generally cannot deduct costs to qualify for a new trade or business.
So let's use an example. I am a baker, and I decide I want to solve the supply chain crisis by becoming a trucker. I pay $6,000 to a CDL school.
Okay.
I can't write that off as a business startup cost.
Generally, no. The IRS views that as the minimum educational requirement to enter a new field. It is a personal education expense like getting a college degree to become an accountant.
That feels insane. You are spending that money specifically to get the job.
It feels unfair. However, we are here to provide solutions, not just complain about the rules.
Good.
There is a workaround for some people.
We love a workaround. Tell me about the loophole.
It's not so much a loophole as a different part of the tax code. It's a credit. It's called the Lifetime Learning Credit, or LLC.
Okay.
Even if you can't deduct the CDL school as a business expense on your Schedule C, you might qualify for this personal tax credit on your Form 1040.
How does that work? Is it better?
It's a credit of 20% of the first $10,000 of qualified tuition expenses. So up to a $2,000 credit per tax return.
And a credit is better than a deduction.
Much better.
Yeah.
A deduction just lowers the income you're taxed on. So a $6,000 deduction might save you, say, $1,200 in tax. A credit, on the other hand, lowers the tax bill dollar for dollar.
So if you owe the IRS $5,000 and you have a $2,000 credit, you now owe $3,000.
Exactly. It's a direct reduction of your tax.
Okay, but what's the catch? Can I just pay Bob's Backyard Trucking School cash and get the credit?
No, and this is the important part. The school must be an eligible educational institution. Essentially, it needs to be accredited and eligible to participate in federal student aid programs.
Right.
And crucially, they must issue you a Form 1098-T at the end of the year. No 1098-T, no credit.
So if you are looking at CDL schools, one of your first questions should be, are you accredited? And do you issue a 1098-T?
Exactly. If you paid out of pocket, don't leave that $2,000 on the table.
What else is in the scraps pile of missed deductions?
Medical compliance costs. Your biannual DOT physical is deductible. Drug testing consortium fees, which owner-operators legally have to pay for to be in a random testing pool, are deductible,
Mm.
and sleep apnea tests and equipment.
Oh, the dreaded sleep apnea test. That can be thousands of dollars for the study and the CPAP machine.
It can be, and since the doctor is requiring it as a condition of your medical certification to drive,
It's a business expense.
it becomes a necessary business expense.
And finally, what about professional services?
People always forget this. Don't forget the cost of the person preparing the taxes.
Right.
Tax prep fees, accounting software like QuickBooks, legal services.
Mm-hmm.
If you pay a lawyer a few $100 to look over a lease agreement with a carrier, that's deductible.
What about, like, industry stuff?
Yes. If you subscribe to a trekking magazine or a membership association like O&I or the Owner-Operator Independent Drivers Association,
Yeah.
those membership dues are deductible.
I always find that ironic. I can deduct the cost of figuring out how much I owe you.
It is the circle of tax life, my friend.
All right, we've covered a ton of ground. We've looked at the OBBB, fantasy versus reality, the brutal math of 1099 versus W-2, the massive power of bonus depreciation, and the trap of the itinerant driver. But it is February. Drivers are panicking. They're looking at a shoebox full of faded thermal receipts that look like invisible ink.
It's a mess.
How do we move from scrambling to strategy? How to fix this for next year?
The February panic is real. The cure is moving to a system. Freight Pro Hub calls it their system, but really it's just about professionalizing your back office, thinking like a business owner.
Step 1.
Track your hours. I know we said the tax credit is in lane 2, the fantasy lane, but if it ever moves to lane 1, it will likely be retroactive.
Right.
You don't want to lose out on a potential $7,500 because you were too lazy to keep a logbook or a simple spreadsheet.
Good point. Step 2.
Digital records. Listen to me very closely on this. Thermal receipts fade. You put a fuel receipt on your dashboard, the sun hits it, and in 2 weeks, it is a blank piece of paper.
I've seen that happen. It's like magic. Bad magic.
It's very bad magic, and bad magic does not survive an audit. If you hand an auditor a blank slip of paper and say, this was an $800 fuel stop, they will laugh and disallow it.
So what's the solution?
You need to be scanning or photographing every single settlement statement, every 1099, every maintenance invoice immediately.
Yeah.
Use an app on your phone. Upload it to Google Drive or Dropbox. Get it digitized.
Stop relying on memory and paper. The IRS has a long memory. You do not.
100% correct.
And step 3.
Classification check.
Oh.
Know before you file if you're a 1099 or W-2. If you are W-2, stop looking for deductions you can't take. You are wasting your time hunting for boot receipts.
Mm-hmm.
If you're a 1099, make sure you aren't leaving money on the table. Do a review. Did I capture everything?
There is one last myth I want to bust before we wrap up. The home office deduction. I see guys online saying, I live in my truck, I do my paperwork in my cab, therefore my cab is my home office.
No. That is a hard no.
Right? I mean, it sounds logical. I do business there.
It sounds logical, but it will get you audited so fast. A home office must be a specific area of your home. Your residence used exclusively and regularly for business.
Mm-hmm.
The cab of your truck is your vehicle.
Yeah.
It is already being depreciated as a vehicle. You cannot double dip and claim the same asset as real estate too.
No double dipping.
Trying to claim a home office deduction for your sleeper berth is one of the most common audit triggers in the entire industry. Just don't do it.
So don't get cute. Stick to the fuel, the maintenance, the depreciation. There is plenty of money there without inventing things.
Precisely. The goal isn't to be creative with taxes. Creative taxes lead to audits. The goal is to be accurate and thorough.
I think that is a perfect summary for everything we've talked about. The OBBB created a lot of noise. It got everyone excited about free money. But the boring fundamentals, depreciation, fuel, correct classification per Diem rules, that is where the real wealth protection is.
It really is. Tax talk isn't about sounding smart at the truck stop lunch counter. It's about keeping the money you earn behind the wheel in your own bank account where it belongs.
So as we sign off, here's something for you to think about. We talked a lot about what you can deduct, but here's a question to chew on. If the industry is moving toward more and more independent contractor models, more 1099s,
Which it seems to be.
but the tax code is getting stricter on verification, on documentation, are you building a business that can survive an audit? Or just a business that can survive the road?
That's a powerful question.
Because like you said, the IRS has a much, much longer memory than a logbook.
That is the ultimate question every owner-operator needs to answer.
Thanks for listening to this deep dive. Keep the rubber side down, keep your receipts scanned, and we'll catch you on the next one.